Good afternoon. It's John Mousseau, CEO of Cumberland Advisors. It is Friday afternoon on November 5th, right before the close. Solid week for equities, good week for bonds. We saw equity markets do well across the board, both Dow and S&P. Same stories of the last few weeks. Basic materials, energy, financials, all doing well. This is the sign of an economy that is coming out of the mess that we were in, and even with the downshift that we saw with Delta variant of COVID. On the bond side, yields down this week across the board. 5-year Treasury bond down about 13 basis points, 14 basis points. 10-year bond down 10. 30-year bond down about 8. This is also a sign that the bond market is taking a cue from the Fed. What happened at the Fed this week? The Fed decided to start tapering, which means they're going to be buying less Treasury bonds and less mortgages every month. About $15 billion less a month. That means their buying program should end somewhere around next July or so. Doesn't mean that they're not being accommodative, it just means they're being a little less accommodative. So the way the bond markets read this is going to be a slower transition to higher rates, and rates which had recently moved up a little bit have been come back down this week. The other thing that we saw this week, which really helped the equity markets, was the jobs number today. Jobs number was expected to be around 450,000, came in at 531,000 new jobs. That is very solid. Not only that, but the last month was revised upward. Another good sign. Unemployment ticks down from 4.8 to 4.6%. Yet another good sign. So it was really a week of pretty good news on top of continued good earnings from companies. So you're kind of in this best of all possible worlds right now, with bond yields remaining stable or coming down somewhat. Equity markets continuing to do well. We'll have next week with both the CPI and PPI to take a look at. You know, our overall view is that interest rates will continue to move up slowly, and that inflation will probably start to come down because you're still at fairly negative real interest rates. In other words, take the yield on a 10-year Treasury at a 145, subtract inflation of about 5.4, and you're left with fairly negative real yields. That should start to go away over time with slightly higher nominal yields and slightly lower inflation. So a good week. We hope you guys have a great weekend. Remember to turn your clocks back on Saturday, and we'll see you next week.